Welcome to the deep dive video update. This is a weekly video where I take the charts that I go through in the daily videos, and maybe I didn't use those all that much this past week, and I put them into this video because we have to look deeper into these charts to see, are we getting any insights? That's why I call it the deep dive video. There are some additional charts that I just include in this particular video. Mainly they're for informational purposes to kind of give us an idea of what's happening in the stock market, but we don't really use these charts to make decisions. This is being prepared for Monday, September 22nd. The first chart I just used in this video, it's a long range look at the VIX, where I have a 50-period exponential moving average showing us the longer term movement of the VIX over time. And we are still down below this red line, which is about at the 20 level, and we're declining. That's what we see. The VIX goes into a lower range when the market is positive. And we were doing that after we finally came out of the bear market in 2022 and started to come up in 2023. We've been coming down, and then we started to run into some problems here about halfway through 2024. And then we really started to go up when things were going down last spring. Well, since that time, we've been able to reverse and go down. Now, this leads me to believe right now, anything can always happen, but if we finally hit a period of weak seasonality, which the second half of September tends to be weak, and we've been hitting all-time highs, but we're seeing internal weakness inside the S&P. Even the NASDAQ 100 is seeing some internal weakness. It's like, okay, now that options expiration is over with, are we going to see some kind of a pullback as we head into the latter part of September? We don't know that. I've been watching for this since halfway through July. I watch for it all the time. And we just look and see, okay, what is the likelihood of something like that happening? It looked like it could happen over the summer, but it didn't. So we have to go with what price is doing. I don't forecast. I just take all the charts. What are they telling us right now? Because that's the only fact that we have, knowing that things will go up or down or sideways from where we're at right now. So if we do start to decline, because we're in a lower range with the VIX, this is to put it in the corner and say, okay, it looks like that'll probably be a decline. Normal pullback, 3, 5, 8, 10% maybe, if even that. There have been times over the last couple of years when we've been able to work off some extreme conditions by going sideways. So we'll just keep an eye on things, but this is looking more positive overall because we're in a lower range here with the VIX. Also, a lot of times I'll use the MACD to say, what is the momentum of the VIX? Is it going up or is it going down? Well, we hit August. Actually, we hit after we got through June through July and August. This has pretty much been flatlining. So I'm like, okay, we're not getting any additional insight from this particular chart here with the momentum. So I dropped it out of the video. If we really start to bounce around with the VIX, then this chart will probably go back in the daily video. Also, we look at the speed. How fast is the VIX moving? Not very fast right now. We're right around the midpoint. We look for an extreme positive or negative reading with this chart, which we're not getting right now. And then we look at the VIX, and there's another kind of indicator of the VIX, the volatility of the VIX. How volatile is the VIX itself? And the VIX measures volatility. So it's like volatility of volatility. And that's a pretty useful tool. A lot of times the VIX of the VIX will get bouncing around before the VIX really starts moving. Well, we do a ratio, the VIX to the VVIX, and as we've been coming down with the VIX, we're also going down with the moving average here. And in this context, as we've been going up, that should be taken as positive. Also, we have another sentiment gauge known as the Ulcer Index, below the moving average, going down, showing there's not a lot of fear in the market. Then we look at the volatility of stocks, the VIX, and the volatility of bonds, the MOVE index. Now, a little bit here, for the most part, when we were coming up out of the April lows, this red line, which is a moving average, has been going down. You notice how it's starting to turn up just a little bit here. So we just want to keep an eye on that. It's not saying that everything's turning over negative, and we did have turn up other times before here, only to have it smooth out and then continue to go down. So we want to keep an eye on this one. Also, the skew index, which I was showing in the daily videos for many days, because when we get up into this red area, that's when I show it. Now, we're still getting a pretty high reading here, and this is a variation of the VIX, where the VIX uses at-the-money options to calculate its current value, wherever the S&P's at. Like, 6,000, whatever. And it looks at 6,000 calls and puts to calculate however it comes up with that. Well, the skew index looks at out of the money options. So it'll look at options above 6,000 and below 6,000, and it comes up with whatever it wants to figure out. And when we get up into this red area, that just means the market is expecting some kind of a big move. Well, we dropped down out of this red area, and it really didn't tell us all that much. There are times when this marks a top or a bottom. A lot of times it's just a continuation. Sometimes it's completely useless. So just another chart that we look at. We make note of it when we get up into the red area. I don't show it when we're down out of the red area. Then we look at the ratio between the large caps and small caps, and we have been coming up here. And you look going back way to 2021, you can see this is large caps outperforming small caps. We're possibly topping out right now, and lately small caps have come back into favor. We're in a lowering interest rate environment with probably more cuts coming in October and in December. And small caps like that because they have to borrow money, and the less it costs them to borrow that money, the more they have for profits. And so their stocks go up. And we're seeing this ratio coming down just a little bit here, meaning the small caps in a short-term sense are outperforming the large caps. But longer term, we haven't even broke below this trend line, this basic uptrend that we've been in now for quite some time. Then these kind of come and go out of the daily videos. We just haven't been getting a lot of insight from them. There are some advanced decline line studies that I show in every daily video. These kind of go in and go out. And we have the advanced decline line for the S&P cumulative based on price. Just kind of chopping around right now. So we set an all-time high on Friday, but we didn't set an all-time high here based on price. That's kind of negative. But look down at the bottom. The cumulative advanced decline line based on volume, that did set an all-time high. And sometimes when volume is actually leading price, we see volume going up where price is not. That means volume is leading. That can be positive for the S&P. And we look at the NYSE cumulative advanced decline line. That actually came down. And we've been doing pretty good overall here. And this is pretty volatile. If we have an up day, it goes up. If we have a down day, it goes down pretty severely here. But we just want to see, is there any weakness starting to come in? Now we look at a regular NYSE advanced decline line. This is still holding up quite well. Then I have another NYSE advanced decline line, which is calculated in a slightly different manner. This is also looking pretty good at this time as well, but not really giving us any additional insight. And we break this out based on common stock. And we're seeing it kind of going sideways here based on price, a little bit more strength, even though we pulled back a bit in Friday's session based on volume. Then this is just for informational purposes on a percentage basis. How much have we gone up from the October 2022 lows? Well, 90.71%. That's a pretty good climb there. And then we had another significant low back in October 2023. We've been up 62.4% since that time. And then we came really down far here in April of 2025. And as of right now, we're up 37.87% from that low. That's just a screaming bounce that we've been in. Look at momentum stocks, where they've been drifting down a little bit as we worked our way into the spring and summer here. We use a ratio of momentum stocks to the SPY. These tend to hold up better when the market's going down. At least lately that's been the case. Because when we were screaming down in March and into April, this ratio was actually going up. That means momentum stocks were holding up better than the S&P, the broader market itself. Then we finally started to come up out of that, and about in May, then we saw this ratio coming down. We did see it go back up a little bit, then it's fallen back. We're more or less, when you take the last few months together, we're more or less range bound for this time right now. A ratio between U.S. and international stocks, also kind of range bound, a lot weaker earlier in 2025. We bounced up out of that. It looked like we were improving, and now we've kind of plateaued out here when you take the last few months together. And StockCharts.com has a thing called technical alerts. If they're green, that's positive. If they're red, that's considered negative. And these are the alerts that are triggered for the whole week. And we start at the bottom. That's what happened back on Monday with the S&P going above 6,600. And the last one's at the top with the S&P setting a new all-time high. There's other indexes and sectors that we look at here. The takeaway from this chart is, what do you see here? Mostly red, mostly green. We're usually looking more positive when we see a lot of green. It's more negative when we see a lot of red. Then we look at what are called technical scores, a scale from 0 to 100. The higher the score, the better looking that particular index. Now, what I'm going to show you, you can do it on a stock, you can do it on a sector. I use it on indexes myself. And coming in first place is the NASDAQ composite. This is 1Q. That's the ETF for the NASDAQ composite itself. And this is looking pretty solid, up at 89.7. And it's the best looking index right now based on technical analysis scores. Then in second place is the NASDAQ 100, the QQQs, which is the NASDAQ 100 ETF. Still looking pretty good here at 86.7. Then, believe it or not, IWM, that's the Russell 2000 small cap index, and it's at an all-time high this past week. Now, there's another small cap index that I follow, the S&P 600. That hasn't set an all-time high yet. So a little bit of a non-confirmation there. I don't deal with the small caps anyway. I just look at them to evaluate the S&P 500. But this is looking a lot better. Just beginning of August, we were down like a 10. And we've been clawing our way back up here, coming in with a score now of 81.2. And we have the S&P itself, which is a balance between growth and value. It's coming in with a score of 75.2. Then we have the Dow, which is setting an all-time high, but not looking really strong from a technical analysis perspective, coming in at 54.8. And then in last place are the mid caps. They're actually under 50 at 49.9. They had been improving, falling back a little bit here and doing okay. If you watch some of the other videos that I do, the growth to value ratio for the mid caps is looking pretty good. But we're not seeing that in the index itself, where the index for the small caps is looking a lot stronger, but the growth to value ratio is not looking very good right now. So a little bit of a contradiction there. All right, then we have a short-term rainbow, 10 periods up to 50 periods. We are clearly in an uptrend. This is a short-term rainbow. We're above the lines are going up. The short-term trend is positive. We want to keep an eye on the 20-period simple and exponential moving averages. I get asked all the time, first of all, how are they different from each other? A simple moving average takes all 20 periods, counts them up, and divides by 20 to give you a value for what is the average price over the last 20 periods. And it counts day number 1 and day number 20 with the same amount of weight. An exponential moving average, it says, well, day number 1 shouldn't be as important as day number 19 or 20, and it weights it a little bit more towards current price, thinking that, okay, it moves a little quicker, it'll be more accurate. Actually, the research that I've studied and looking at this for decades, I found that the simple moving averages are actually more accurate because they don't move as fast, and they help you from pulling the trigger too quick, either to get in or get out. But that's the basic idea. Now, what we're watching this for now is we're well above the 20-period moving average. In fact, I have another indicator called the boom indicator that measures the current price of the S&P in the distance to the moving average. And we're pretty far. It works like an oscillator. When we get too far away, price has a tendency to come back to the moving average. And so this is rather extended right here. If we do start to see some kind of a pullback, we'll be watching the 20-period moving averages to see if they offer support. Now, ever since we got out of that bumper cars down here in April, where we're just bouncing around all over the place, you notice that for the most part, everything that we've been seeing here, except for one day, this is when the August employment report came out, and it freaked the market out, and we dropped below the 20-period moving average, only to get back in above it the following Monday. And we dropped down periodically here, but this has been acting as support. So if we do see a pullback, we'll be watching to see, okay, are these levels going to hold? Because if we can come down, if we do see a decline, come down here, the market does what it wants to do to have a correction, to take some profits and so forth, and then we come back up out of that, that's quite healthy. But if we drop down below the 20-period moving average and then stay down there longer for maybe one day, then, okay, maybe things are going to get a little more serious at this point. Then we start watching the next chart, which is the 50-period moving average that I'll show here in a second. And then this is an intermediate term rainbow, going from 50 periods up to 100 periods. Intermediate term trend is clearly positive. This is the 50-period simple and exponential moving average. If we do drop below the 20s, we'll start to follow the price to see if it goes all the way down to the 50s. If it drops below that, then we look at the 100s. And these are anchored moving averages. Now, where moving averages use past price to get their current value, anchored moving averages they try to project things forward. And since we're going up and making all-time highs, we have a whole lot of lines here. And some of these are attached to pretty significant lows or pretty significant highs. And you can see if we do really start to come down, there's a lot of lines in here that could are potential areas of support that we would follow. And even this low that we set here, we're well above that. And then there's another one, kind of this sickly looking green color here. Then that might be a support level to watch as well. And notice that all the lines are going up. And so that's positive also. Okay. All right. Then I did show this a few times throughout the past week because we were going up and closing outside of the upper Bollinger Band. We're not doing that now. We're back inside the Bollinger Band, but not by very much. This line is at one, we're at 0.99 right now. Now, we could take that as positive because we're going up, the midpoint's going up, and we're above the midpoint. That's all positive. When we do get above the upper Bollinger Band here, and for that matter, the lower Bollinger Band, we tend to not stay there very long. So that's kind of considered a significant event. And so I watch this every day. I only show this chart in the daily videos when we're looking at extreme positive or negative. Connor's RSI, use it just like the other oscillators that we use for extreme positive or negative readings. We're not seeing anything extreme currently. And this is, and again, I always warn about this. When I'm doing the percentage changes here, and I have to clear my throat. Sorry about that. You gotta love take one videos here. I eyeball this and I go, okay, that looks good. And I click it and then that's where it goes. And that's the percentage amount. So there's nothing necessarily scientific about this because I'm just having to eyeball these things here. But these are just percentages of, okay, how much have we gone up from significant lows? When we've had pullbacks, we want to keep an eye on the percentage of those pullbacks because those mean something. So if we do finally top out and start to come down, I'll be watching the percentage of the decline and see if that gives us any additional insight. We look at the S&P 500. We also compare it with the S&P 100 because the S&P 100 are the biggest stocks that make up the S&P 500. They're more or less going in tandem with each other. When we look at this on a ratio basis, which is not what this is, the S&P 100 is outperforming the S&P 500, and that's positive. All right, then the mass index, we're not generating a signal. We only see a signal if we get up to the red dashed line or the blue line. We're not there now. Standard deviation, we got close. This measures the speed, either up or down. It's not measuring direction. And when we go above the moving average, that's when I start to show this in the video each day. When we got right up to the moving average, and now we've been coming down again. So we haven't been seeing a real explosive movement. Praying bottom fisher, we did get a buy signal about halfway through August here. No, now that's gone away and we're still declining with that. And this did appear in one or two videos throughout the week. When we went above 66.50, we drew in a new X here. Well, after Friday, we didn't go any higher. So that's why these X's are black right now. But this is the point and figure chart. It just measures price. It doesn't measure time. And this is looking positive overall. We're still working on a triple top breakout that was generated back on August 13th. Long-term rainbow, 50 periods up to 250 periods. Above the lines, all the lines are going up, positive. The daily special K chart, we crossed over back in August. We are positive. This is a longer term oscillator. I don't show this in the daily videos because we didn't even get any signals in 2024. The signal is when we cross above or below the red line. Well, that never happened. So there was no need to show that then. And this is what I call an apples to oranges comparison. We're looking at the S&P 500. That's the bar chart. And then we're looking at the NYSE advanced decline line. Now, if you remember back a few charts, we have an advanced decline line for the S&P 500 itself. This is the NYSE advanced decline line. That's why it's apples to oranges. We're taking a broad market measure, which is the S&P, and then something that's even more broad, which is the NYSE advanced decline line, and just watching them to see how are they performing. Well, seeing a little bit of a negative divergence right now, where we've been going up with the S&P, at least in Friday's session, then we came down with the NYSE advanced decline line. Not a huge deal. We see these get out of line with each other, but you notice back here, this was giving us a warning back in late 2024. It's like, okay, something's not right here. We're seeing the red line going down pretty fast, and then we're kind of going sideways here with the S&P, and then we saw a pretty significant drop after that. So we just want to keep an eye on this. Sometimes that'll give us some clues when to see more of a confirmation that we're looking more positive, or that there's something we should be concerned about. Weekly chart of the S&P, weekly chart of the DAX are actually, they have a pretty strong tendency to go in the same direction at the same time. We're seeing that really coming down as the S&P has been going up, and the German DAX, which is the biggest market in the EU, that's been just kind of chopping around at these current levels. Then some support and resistance. This is a 20 period simple moving average of the open, high, low, and close. What I found, I developed this decades ago, and for a trading system that I was doing, I don't do the system anymore, but I kept the indicator because even though this is based on 20 periods, this sometimes can act as a support or resistance area. And you see this little mini rainbow here, where sometimes if we're going up and we'll fall back down into the rainbow, a lot of times that will act as support. If we're going down and we go back up, sometimes that'll act as resistance. Well, we're well above the rainbow, the lines are going up, so we're not getting anything from this chart that we aren't getting from any other charts. Then the Ichimoku cloud, kind of the same thing here. We're above the cloud, that's positive. Then short term is the green line, that's going up. The blue line is intermediate term, the red line is long term. They're all going up. We're above the cloud, it's positive. Broad market measure, the VIXN, gotta love that name. This is the volatility of the NASDAQ 100. I don't use this chart all that much because I mainly focus on the S&P 500. And here are the QQQs. When we were coming up, coming down, bouncing all around here, a lot of times we'll hit these moving averages first before we hit them in the S&P 500. So I like to keep an eye on that. We came down, but this is that dip down below the 20 period moving average back on August 1st. Well, then we quickly got back above that. We fell down. But you notice here, we came all the way down to the 50 period moving average with the Qs, but that held. And so that's why we want to watch moving averages on other indexes outside of the S&P, because we might be getting support from one of those other indexes. And we're like, okay, the S&P stopped going down. It's bouncing up. We can't find anything. Why are we hitting that spot? Why did we stop right here? And sometimes it's because we hit support on another index, specifically the NASDAQ 100 or the NASDAQ. Now, I've seen it happen with the mid caps, not too much with the small caps. But there was a time back in 2024 when we were going down, we were having a pullback, and the only support I could find was in the mid caps. It was a pivot point, and we hit that, we bounced up off of it, and then the market ended up coming up off of that as well. That's another reason for watching a lot of different indexes. Okay, we look at the S&P on top, and then this is a growth to value ratio, the Qs to diamonds, and we see that there's a pretty strong correlation here, meaning that the Qs are outperforming the value part of the diamonds, and we're going up with not only with this ratio but with the S&P itself, and there's a pretty strong correlation. That's positive. Then we look at the Dow and the transports. We are seeing a negative divergence here that if you're a pure Dow theorist, you'll go, oh my gosh, we're going to fall apart. Well, we see the Dow going up and we see the transports really underperforming right now. That's a non-confirmation according to traditional Dow theory. I don't put a lot of importance into that, but there are some people that do. So I look at it, I've studied it, and I just want to keep track of it, but I don't make decisions around it. Then we look at regional banks and do a ratio with the financial sector. Doing okay here. We're actually generating a golden cross with this ratio. Now, when this thing really tanked, this is back when Republic Bank and Silicon Valley Bank, when they fell apart, and we were kind of stabilizing here, and then New York Community Bank fell apart, and we've been kind of waiting to see, okay, are other smaller banks going to be problems? Well, so far not really, but we haven't seen an awful lot of strength coming back in with this ratio. We are seeing some improvement here. We're above both the moving averages, and as I said, we just generated a recent golden cross. And the banks, not doing great, but not doing terrible, just kind of going sideways right now with the bank ETF. We look at a ratio between energy to the 10-year bond. Now, this was really going up back when we were in 2021 and 2022. This was giving us a heads up. Look out. 2022 could be difficult. It was difficult. We were seeing a bit of a headway to what was happening here while this ratio was going up. Since that time, we pretty much have been going sideways, so we're not really getting much insight from this ratio. We just keep an eye on the gold to S&P ratio. Where I'll really pay attention to this is if we come back up to this trend line here to see if it ends up providing some kind of overhead resistance, and we're not there yet. Emerging markets versus developed markets. We have been coming back up. Emerging markets are doing pretty good right now, especially when you look at them compared to developed markets. Now, developed markets would be the US and Europe. And then emerging markets are kind of the other world markets that sometimes folks like to get into. Then this is a crazy study. The 10-year yield in the US, the German 10-year yield, we actually subtract it. That gives us a positive answer because US rates are higher than German rates. And then we plot the US dollar index down here. And believe it or not, now they've been going in opposite directions. But we're seeing this correlation starting to get stronger again. So there's actually a relationship between US, German interest rates and the US dollar index. And it tends to spend a lot of time in a correlated relationship, going up or down together. The German DAX, as I said, we're just kind of drifting down. We're setting all-time highs with the S&P, Dow, NASDAQ, NASDAQ 100. We're drifting a little bit here with the German DAX. And we look at a ratio. Now, earlier in 2025, this was just screaming down here. That's one of the reasons I really watched this chart. This is the S&P underperforming the German DAX. And we bounced around all crazy with all the tariff tiffs that were going on, tariff tantrums, whatever you want to call them. And then finally, as we've been coming up out of this, we are seeing an overall improvement as U.S. stocks are starting to outperform German stocks. But we look at it on a broader scale. We look at U.S. stocks to global stocks. They're still not really outperforming with any real conviction right now. Rate of change charts, I use these for information. Very long term, 250 periods. Still looking pretty good with this chart. This is the same chart just going back to 1980, where we are going up with this chart as well. Then this is what the market is telling us. Is it concerned about inflation or not concerned? We look at a number of different ratios here. And we're coming down overall, even though we bounced up just a little bit. This is cash to 3 to 7 year bonds. Now, when this ratio is going up, that means the market's concerned about inflation and interest rates. When this ratio is going down, that means the market's not concerned. And we're still basically in a downtrend here overall. The Fed came out and they cut rates this past week, and the market's all happy thinking there's going to be more rate cuts coming down in October and then again in December. So we're seeing a little bit of jockeying around here, but this chart is telling us no, the market's not concerned about inflation or interest rates. We look at tips, which do adjust for inflation and interest rates. When inflation and interest rates are a concern, this ratio goes up. When they're not a concern, this ratio goes down, and we're just kind of going along sideways. A little bit of an uptick here, but we're not really breaking out of this recent range that we've been in. And also kind of range bound here. When we look at tips in 7 to 10 year bonds, we go a little further out. Just pretty much range bound right now. Not really giving us any warning signs. Then we look at the long-term bond, which is in blue. That's the TLT, and the S&P 500, which is in red. The longer-term correlation is getting stronger, but we're actually working our way back down to neutral with the shorter-term correlation. You can see here recently where the S&P, the red line's been going up as the blue line's been going down. That's why we're seeing the short-term correlation really drop here. We're going to be keeping an eye on that to see if that's giving us any clues there. And we also see a strengthening with the long-term correlation when we look at the Qs to the TLT here. That's still looking pretty solid there. And then we've been seeing a general dropping here of the 2-year treasury yield, which interest rates going down. That's more positive for the market. We want to keep an eye on retail, kind of starting to go up just a little bit here with this ratio. We have the retail to SPY ratio, which had been underperforming going all the way back to about 2021 or so. And it seems to be bouncing up just a little bit. We did get retail sales, and they're looking pretty good right now. They came in much stronger than expected. And so the retail chart itself, we're in an uptrend. We're above both moving averages. We're above 50 here with the RSI. That's looking pretty solid, but not necessarily outperforming the S&P itself. Then we look at a bunch of different ratios here. Discretionary to staples. This is the weighted version of these sectors. That means Tesla and Amazon account for a huge part of how this chart moves. And it's been going up. Tesla and Amazon have been doing pretty well lately. Then we look at an equal weight version of those same two sectors, discretionary and staples. So Tesla and Amazon don't account for as much, but still, this is looking pretty good overall. So we're seeing confirmation between the weighted and equal weighted version of those sectors. Then we do some growth to value ratio studies here. Tech to utilities. Utilities are outperforming. That's positive. Biotech to healthcare. Growth to value. Now, we did come down a little bit on Friday, but we have been seeing where biotech has been outperforming. That's growth. That's good. Not really seeing much here when we look at hotels to utilities. It was outperforming and now it's kind of pulling back and just kind of going sideways right now. But we are seeing some strength in some of the other areas. And we look at what are called bellwethers. These are the semiconductors, really close, if not at all-time highs. Home builders drifting down just a little bit. Now they like it that interest rates are going down, but we'd like to see this be a little stronger. Transport's just going sideways right now. Retail did come down on Friday, but it has been looking okay. And then these are the regional banks here, where we are pretty much range bound. We dropped down a little bit. Now we're coming back up to the higher end of the recent range. So not getting any real insight there. Then this is another apples to oranges comparison. The Eurozone, European, to American bonds, still looking pretty good. This is showing that the Eurozone stocks are outperforming even American bonds currently. Then we have these different studies here. These are the percent of stocks that are above their 200-day simple moving average in the S&P. This chart I use like an oscillator. We look for being extreme positive or negative. We're not seeing that now. The takeaway is that we're above 50, even though we did decline a little bit in Friday's session. In the bigger picture, this is still looking positive. Then we look at those stocks in the S&P above their 50-period moving average. We're still above 50 here. And we look at the mid caps, still above 50, and then the small caps actually looking a little bit stronger here. Just to give us an idea, what are the internals looking like in other indexes, not only just the S&P 500. And then we look at an SPY to Staples ratio, and this is going up, and that's positive. If we get concerned about something, it'll be if we see this ratio really starting to go down, like we were seeing earlier on in 2025. We're just screaming to the moon and setting all-time highs with this ratio, and that is quite positive. Thank you. I hope you found this helpful. Have a great weekend. I will talk to you in the next video.